Okay. Good morning, everybody, and welcome to today's presentation. VAT update, COVID-19 and Brexit. Thank you for switching on and listening in this morning. The presentation has been conducted by myself, Jeff Ruddle, and by my colleague, Toby Thorne, both senior managers at James Cooper Creston. Just for background, I spent over 25 years with the HMRC and worked in a range of VAT areas, dealing mainly with VAT training, compliance, and investigation. Obviously, in recent years, I've been working for James Cooper Creston, providing VAT compliance and advisory services.
Thanks, Jeff, and good morning, everyone. My name is Toby Thorne. As Jeff mentioned, I'm also a senior manager in our VAT team. I've been with the firm now for 8 years. I joined as a student and gained my AAT, my ATT, and finally my Chartered Tax Advisory qualification, or CTA qualification, 5 years ago. So I've worked in the VAT team ever since I joined the firm, and although I still do assist with and review compliance work, most of my time is now spent providing VAT advisory services also.
Thanks for that, Toby. There are no polls, just for awareness, there are no polls in this webinar, but if you have any questions, please feel free to post these to the Q&A section, and hopefully we'll have time to answer some of these at the end of the presentation. I'd also advise that the presentation itself will be recorded and you will have access to that on our website today. Anyway, today we'll be looking at aspects of the HMRC COVID-19 relief, in particular relation to VAT, and providing an update on the impact and considerations of Brexit as we see it in a minute. Basically, with the changes to COVID-19, we'll be dealing with areas around the VAT payment deferral scheme, for which payment terms have now been extended. We'll be looking at the temporary reduced VAT rates, which changes the VAT rates that mainly affected hospitality, and looking at the VAT liability of PPE, personal protective equipment, and there's been recent changes in that area too. Slide 3 is just a quick summary of what we're looking at with Brexit. We'll have a quick look at the timeline, the effect on the supply of goods, the effect of Brexit supply of services, some other tax implications and some non-tax implications, and a quick look at some key points. And in view of that, I'll now pass back to Toby to continue the presentation.
Thanks, Jeff. As Jeff mentioned, we're going to do a quick recap of some of the government initiatives to support business during the coronavirus outbreak, and then also confirm the current status of these initiatives. So the first one is the VAT payment deferral scheme. So on the 20th of March, the Chancellor announced that VAT payment deferrals, these were introduced to assist with cash flow for businesses during the initial trading periods. This meant that all VAT registered businesses in the UK had the option to defer VAT payments that were due between the 20th of March and the 30th of June. So this therefore covered the VAT return periods ending 02/20, 03/20 and 04/20, as well as any annual accounting payment scheme or payment on account payments due during this time. There were some VAT payments that weren't covered or didn't qualify for the deferral, being payments of import VAT, customs duty, machine game duty, any VAT due to be paid in relation to disclosures and assessments, and then any time to pay arrangements for payments due before the 20th of March 2020. This deferment was automatic. Businesses did not need to inform HMRC if they wished to defer payment. The business could opt into the deferral simply by not making VAT payments during this period. There was, of course, still the option for a business to continue to make payments as normal if they wish to do so. So any business wanting to take advantage of deferral then has to make sure they've paid this VAT before the 31st of March 2021. Any payments then due after the 30th of June had to be paid in full as normal. There was then a further government announcement on the 24th of September this year, which stated that any business which is unable to pay this VAT debt by the 31st of March 2021 could choose to defer the VAT debt further still. If you go to the next slide, please, Georgia. Thanks. So the deferred VAT would then be split into 12 equal monthly payments over the year to 31st of March 2022. So unlike the initial scheme, this scheme does require the business to opt in, although HMRC haven't actually announced any details on how this is done just yet. One thing we do know for sure is that the business will need to have a direct debit set up to allow HMRC to take the monthly instalments. Next slide, please, Georgia. So next we have the temporary reduced VAT rate. So I appreciate the summer period is now well and truly over, but it is worth just recapping the position regarding the temporary reduction of VAT that still applies in specific sectors. So the main idea behind the measure was to help protect jobs in the hospitality and tourism sectors, which is estimated to be about 2.5 million jobs. A lot of those jobs have already been lost in these sectors, particularly part-time jobs, mainly taken on by young people. But in summary, on the 8th of July, the Chancellor announced that the VAT rate in the hospitality and tourism sector will be cut from 20% to 5% for the period running from the 15th of July to the 12th of January 2021. However, on the 24th of September 2020, the Chancellor announced an extension to this temporary reduction to remain in place until the 31st of March 2021. The reduced rate applies to the sale of food, accommodation and admission to attractions. So that includes eat-in and hot takeaway food from restaurants, cafes, pubs, accommodation and catering in hotels, B&Bs, campsites, caravan sites, etc. And then attractions, so cinemas, theme parks, zoos and similar establishments. So just something to bear in mind, any business that serves all of the above as well as alcohol will then have to deal with 3 different rates of VAT, one for alcohol at 20%, one for cold takeaway food at 0% and 5% for everything else. The 20% will then also apply to confectionery type products such as crisps and sold as part of any supply. So just potentially slightly more complex than some of those businesses would have been used to before the pandemic. So it's just important we're getting those VAT rates correct. And then it is estimated that the cost of this reduction and the subsequent extension to the Treasury is about £3.3 billion. So yeah, big cost to the Treasury. So finally, back in April, the government also announced a 3-month temporary zero rate relief for the sale of personal protective equipment, so PPE, within the UK. Previously, most sales of PPE in the UK were standard rated at 20% VAT. However, with the effects of the pandemic throughout Europe, the European Commission supported the application of temporary VAT reliefs that directly related to the mitigation of the impact of COVID-19. The temporary relief was to apply to all suppliers of PPE commencing from the 1st of May, ending on 31st of July, but this was subsequently extended to the 31st of October 2020. But surprisingly, was not then extended any further, so it did end on 31st of October. So the status of the customer, the buyer, is not relevant. All sales of PPE in this period were zero rated. And there's a list of some of the products that were covered by the zero rating. For care homes and the healthcare sector, companies can access PPE from the Department of Health. However, the VAT charge will apply to the onward supply to businesses and the public. So the initial measure did apply to PPE approved for use by Public Health England and was aimed in particular at care homes and similar to help them buy stocks of masks, gloves, gowns. The total saving to care homes and companies is thought to have been more than 300 million over that 6-month period. The private sector businesses in food, wholesale and retail sectors, as well as ordinary consumers like ourselves, are not able to access the PPE supplies, and their purchases are now subject to VAT at 20%. I'll now hand you back to Jeff, who's going to start going through the preparation for Brexit slides.
Thanks for that, Toby. Now we're just going to have a quick overview of what areas businesses need to consider in relation to Brexit. Firstly, we'll have a quick look at the Brexit timeline to date, which I hope is right because the dates seem to change all the time. Anyway, Brexit negotiations are ongoing and there's still significant issues over things such as EU access to fishing waters, British fishing waters, issues over competition rules for companies, especially in relation to government subsidies, and mechanisms for resolving future disputes. So despite the changes at number 10, it is still thought that Boris Johnson is perceived as taking a hard line on the negotiations, and we still hear talk of a full no-deal Brexit. The pressures on negotiators are still both economic and political, and every day there's something in the press about it. Although there does seem to be support from Rishi Sunak for a deal, Boris does have other influences from those who would strongly be critical of any Brexit compromises. So at the minute, it's still not clear what the deal will be, if there is one, and it's still not clear what will be compromised, if there is one. Though in the past few days, there has been some talk of more positive attitudes in trying to get things sorted out. So in summary, the UK left the EU on the 31st of January 2020, and this established the commencement of the transition period that we're in, but this is due to end on the 31st of December 2020. So in effect, the government's already committed to leaving the customs union and the single market. And it did have an opportunity to extend the transition period we're in back in June, which is that 30th of June date, but it chose not to. So the 31st of December is the absolute deadline date. So the choice now really is a bit of a hard Brexit with a deal or no deal. And we also are aware that as from the 1st of January, there will be a separate protocol for Northern Ireland and a requirement for customs checks on the movement of goods from the GB to Northern Ireland. However, it's clear the arrangements on that are still not in place, but discussions on the full trading around that. We've decided won't be included in this seminar. That's really a whole issue in itself, and that will be for another day. For the mainland UK businesses, what we need to look at is things like borders and immigration, freight issues, trade tariffs, duty classifications. All these things will impact the south and the southeast. And we've all heard stories in the press about the issues at Felixstowe with 11,000 containers stuck there, said to contain PPE. So basically, this discussion has a large caveat, as discussions and negotiations are ongoing and anything can change. So next slide, please. What we're going to look at first is just a quick look at supply of goods in relation business to consumer supplies. So in effect, this really relates to mainly e-commerce type sellers. Some of the issues we're looking at is the loss of distance selling thresholds and a requirement to register for VAT in the EU. Distance selling is when a business supplies and delivers goods from one EU country to another customer in the EU, basically to a private customer in the EU. So it refers business B2C supplies, business to private consumers. So distance selling basically allowed a UK company to trade across Europe B2C without the need to register, as long as it traded within certain thresholds. In the main, up to about €35,000 in most countries. If you did exceed that threshold, there was a requirement to register. As the UK will leave the EU regime after the 31st of December, this will mean a loss of those distance selling thresholds for the UK e-commerce sellers of goods to EU customers. So the goods will now be subject to import VAT, and UK sellers will have to consider VAT registering in Europe immediately if they're going to be involved in e-commerce. Similarly, any EU e-commerce sellers into the UK would need to register for UK VAT if they're selling to UK consumers. So one of the issues around that is will you need to appoint a fiscal representative in the EU countries. At the moment, there are about 19 of the 27 member states where you may have to appoint a VAT fiscal representative. These agents will quite often have direct liability for any unpaid VAT and often will require cash deposits or bank guarantees. If you're a distance seller, you will have issues over who pays the import VAT. In essence, you'll need to review your delivery terms so it is clear to your customer who accounts for the VAT. So when you're supplying goods to consumers in the EU, they will be they could end up being responsible for paying the import VAT and duty unless you have operate a deferred scheme or unless you've built it into your pricing. But not every country does it consistently, and it's slightly different in each country. The last item on this slide refers to Amazon sales. So if you sell by Amazon, we would really recommend that you follow the guidance in the Amazon Seller Central portal. And also you need to be a registered seller with Amazon to do this. So basically what has been happening, if you're sending goods into the EU from a UK fulfillment centre, this is no longer possible, and you will be required to hold goods in the centres in 6 different countries in the EU, but Amazon will tell you which of those countries they are. But it will mean you will have to import directly into Europe for access to EU customers, and you will end up with a requirement to register for VAT. So the UK seller through Amazon will have to pay EU import VAT and tariffs and complete relevant documentation for the future. Next slide, please. What we're going to look at here is the main impact of the UK's departure from the UK felt by companies involved in business-to-business supplies with business customers in the EU and suppliers. The EU VAT directive did allow all EU states a degree of harmonisation for the indirect taxes, and the Union Customs Code, which governs these, was agreed throughout Europe. Businesses will now have to be more aware of where they fit in, as well, the businesses as to who acts as an importer and who acts as an exporter of goods between the UK and the EU, as there will now be responsibilities to submit customs declarations and account for any VAT or duties due. So will there be a requirement to register for VAT in the EU? Basically, after the transition period, as we said, all B2B supplies of goods will lose a zero rating status. The sales of goods to Europe will become exports, with customers in the EU treating these as imports. So you will need to consider if your clients in the EU can arrange import, taking title to the goods. But obviously they may also end up with duty costs. So there's duty and VAT implications both for your client. If you end up being responsible for completing the export declaration as the goods leave the UK, as well as the import declaration when the goods are imported into the EU, you will need to consider registering in the EU where you've taken title to the goods. This applies in instances as well where you hold consignment stocks of goods in the EU. So if you hold consignment stocks of goods in the EU and you are not currently registered for VAT in a member state, you will need to register from January 2021. If you use the VAT triangulation procedure to sell goods B2B in the EU, you must register for VAT in an EU member state. The triangulation simplification is only a measure within the EU itself. So if there's an outside country, which we will be from January, then the triangulation rules don't apply. At the bottom, we've mentioned postponed accounting for import VAT in the EU. We've mentioned that because quite a few countries in the EU operate postponed accounting for import VAT, so there's no cash flow impact for your customer in all but 4 states. So it's a negotiating point, which might facilitate you not having a requirement to register. But you may wish to review your delivery terms with EU customers to determine who's responsible for the customs entries and import VAT and duty. And basically, the member states that we're talking about that don't have postponed accounting is Germany, Italy, Slovakia, and Cyprus. Can we move to slide 13, please? So in the supply of goods, we'll have a quick look at some of the import and export requirements. Firstly, we're going to look at the EORI number, the Economic Operators Registration Identification Number. For those of you involved in moving goods, you'll know that in order to import and export goods from the UK businesses, you will require an EORI number. So basically, it's an identification number used for all customs procedures. If you're trading, from UK to EU, it wasn't a requirement, but now that we're a third party, it will be. HMRC have issued these to all businesses identified as being involved in EU trade as per their VAT returns. So if you have indicated on your VAT return, boxes 8 and 9, that there's EU trade going on, you should have been issued with your EORI number. which will look very similar to your VAT number. If you are trading in goods with the EU, and you haven't got one, you should apply immediately to HMRC to obtain one, and it is relatively simple to get. But you must be aware that if you are a business that takes title to goods in the EU, you will need a secondary number connected to your EU VAT number, as you'll have to make customs declarations in the EU. And you can get this from the relevant authority in the EU country where you are to make those declarations. So in effect, that does create a requirement to register for VAT in an EU country, but not all countries are operating this the same way. Right, postponed accounting for import VAT in the UK. From the 1st of January 2021, basically UK VAT registered businesses can account for VAT on imported goods on their VAT returns. So basically, all rest of the world imports and EU imports will all be treated as the same thing. And we term it postponed accounting, and it applies regardless basically where in the world the goods come from. The change does bring a cash flow benefit to businesses involved in this, because you're able to declare and recover, subject to the normal rules, import VAT in the same VAT return. So you don't actually have to physically hand money to British Customs when you bring the goods into the UK. There is no requirement to obtain permission to apply postponed VAT accounting, but VAT must be accounted for in the VAT return, which includes the date on which the goods are imported. So in essence, you pay the import VAT in box 1 of your VAT return and claim it back again in box 4 of your VAT return in the same period. Import duty rates for goods arriving in the UK. If there's no agreement, but the UK will lose any preferential EU negotiated rates and conditions, and will have to trade on WTO terms, which does mean the possible imposition of tariffs on certain products. The tariff code used in the EU is pretty much replicated in the UK tariff, but potentially there are different custom rates for each code. So you need to check the UK tariff to find the import duty rate for goods arriving from the EU after the 1st of January. But bear in mind, more than 80% of imports into the UK have a nil rate of customs duty. So if you identify that there's a positive rate of duty on the goods you're bringing in, you will need to consider whether any onward sale will require a pricing amendment to that. And you also need to discuss any impact with your customers. The government's already published the UK tariff nomenclature, and we should have put the link onto that file, but we haven't done it. Well, it's www.gov.uk/check-tariffs-1-January-2021. But we will, if you require that, just ping us. We'll get that sent out to you straight away. It's also available, of course, on the HMRC website, which might be quicker. We'll look at the quick temporary movement of goods from the UK to the EU or vice versa. If you move goods temporarily for processing from the UK to the EU or vice versa, and the goods attract positive rates of customs duty, you'll need to research whether temporary import relief application is possible or in effect desirable. There will be changes to the low value consignment relief. So if you regularly import goods from overseas with a value below £15 and use existing low value consignment relief, so import VAT is not paid, you need to be aware that this relief is scrapped from the 1st of January. And it will be replaced by a system for goods with a value below £135, where the overseas seller or the postal provider will have to charge VAT to you and declare it and pay it to HMRC. So suddenly something that small is going to get quite bureaucratic. And some other transitional implications for the first 6 months of 2021. If you import goods from the EU that are not controlled goods, such as alcohol, there are transitional simplifications for the first 6 months of 2021. So the government has actually introduced mitigation measures where the importers of non-controlled goods do not have to immediately submit a full customs entry, but instead can record the transaction in their own records and pay customs duty, if applicable, within the following 6 months. You do have the alternative of putting in a full customs entry straight away. But in general, you should be aware there will be a loss of a lot of simplification in filings. So therefore, all movement of goods to and from the UK will be treated as imports and exports. What we would advise that the completion of any relevant export-import documentations can be complex and errors will cause delays. So if you haven't been involved in SIDs, ESDs, C88s, HMRC computerized systems, ports involving freight, we would recommend that you use a freight agent who has direct access to the customs import online systems. You can submit any import and export entries on your behalf. And I mean, it does appear at the minute that the government's also trying to bring in a new import-export system, but it's having problems with that, which may cause delays at the ports. But we would recommend you seek out the advice of an experienced freight forwarder, and if you have any involvement in those activities. I'll just pass back to Toby now to continue talking about Brexit.
Thanks, Jeff. Yeah, so continuing on, I'll start to talk about the impact on services. So Brexit will also impact the supply of services between the UK and the EU, although not to the same extent as the supply of goods, as much less impact on services. Businesses that will be affected are those that sell e-services to private consumers, so B2C sales, and submit a mini one-stop shop return, also known as a MOS return, to HMRC. So you will no longer be able to use this return to declare the sales or the EU member state sales, and will have to register for MOS somewhere in the EU. This registration could be in the country or one of the countries that you make MOS supplies into, or for ease, you could choose to register in an English-speaking member state like the Republic of Ireland, or we've registered some clients in Malta because they're also English-speaking. Whilst the trading agreement has yet to be finalised, it is not expected that the UK's place of supply rules will change to any large extent after the end of the transitional period, so end of this year. Therefore, most B2B transactions will be treated as falling under the general rule, and therefore treated as taking place where the customer belongs. So VAT will not be charged on these supplies based outside the UK. However, there are some exceptions that will remain. So there are services that could have a different VAT outcome post-Brexit. The rules apply where the normal place of supply rules would mean that they take place outside the UK and therefore escape UK VAT, that are actually used and enjoyed inside the UK, or alternatively the opposite. So situations where the normal place of supply rules are that they would be subject to UK VAT, but are actually then used and consumed outside of the UK. So services such as hire of goods, including means of transport, B2B supplies of electronically supplied telecommunication services, and then B2B supplies repairs to goods under insurance claim, radio and telephone broadcasting services. So yeah, so there still will be some exceptions, but for the most part, B2B sales are going to be outside the scope of UK VAT. If you do make B2B sales to EU customers and you currently zero rate your supply under the general rule, place of supply rules, you will no longer need to quote their EU VAT number on your sales invoice or include the phrase subject to reverse charge or words to that effect from the 1st of January next year. Something else that's going to be lost is the simplification for the installation of goods in the EU. So again, this is B2B supplies. There's currently a simplification allowed under EU rules that permits a UK VAT registered customer to treat the supply as an acquisition, and the EU supplier from another member state to treat it as a zero-rated dispatch from its home registration, and vice versa. Other member states currently operate the same simplification. This, of course, ends when the transitional period does, and whether it's going to be replaced with other easements remains to be seen. Reverse charge procedure will continue to apply for all services purchased from outside the UK, So nothing's changed there for UK VAT registered businesses. And then finally, just something to consider is the impact of meeting EU regulatory requirements for sales of services to the EU. So in particular, the financial services, transport, media, energy providers, and suppliers that hold EU professional qualifications for lawyers, architects, doctors, vets, etc. So that's just something that we need to be considering. So some other tax implications of Brexit. End of the EC sales list. So the final submission for EC sales will be for the period up to 31st December 2020. End of Intrastat declarations. So final dispatches declaration will be for the period up to the 31st of December 2020. Final arrival declarations will actually be for the period up to the 30th of June 2021, as they are still going to be required during the transitional simplification period, which Jeff just mentioned, which is for the first 6 months of 2021. And then finally, EU VAT refund claims will also cease. So if you regularly submit claims to HMRC for refunds of VAT incurred in the EU, such as hotels, conference costs, etc., going forward, you will have to submit non-union claims, which are known as 13th directive claims, and those need to be made direct to the member state where the cost was incurred. So the last claims for the EU VAT refunds will be for 2020, and just know that these will need to be submitted by the 31st of March 2021. So only got 3 months to submit them when 2020 is over. Then some other just sort of non-tax or non-VAT implications, things that we need to consider. Well, the main one probably going to be, so the impact of the increased cost and admin burden of moving goods to or from the EU, primarily the submission of a full import and export entry to customs. So there's going to be additional paperwork required there due to this, well, the fact that it's now an import and an export on that movement of goods to or from the EU to the UK. So it's likely that freight forwarders' costs will increase, or if you are going to be responsible for the paperwork yourselves, this of course then increases your admin burden. How significantly it increases it will depend on the amount of imports, exports that you have. If you move goods from mainland England, Wales or Scotland to Northern Ireland or to the Republic of Ireland via Northern Ireland, there are going to be special rules and forms to complete. So if this applies to you, you need to consider even more additional admin burden. If you buy goods from the EU, consider whether you've got sufficient stock plans for the early 2021 to cope with, well, possible delays at the UK ports. And then the flip side of that, if you sell goods to the EU, consider whether your business customers have sufficient stocks of your goods in early 2021, again, to cope with the possible delays at UK ports. And then finally, consider the impact of meeting EU regulatory requirements for exports of goods to the EU, particularly for motor vehicle type approvals, medical devices and medicines and labelling. So all things that we need to consider. And then finally, we appreciate that we've covered a lot of information, so we just wanted to end on a slightly more light-hearted slide. If we can dream about going on holiday again. I suppose the first point is tax/duty related. So if no deal, personal duty-free allowances for travellers returning to the UK from the EU will fall dramatically. For example, the duty-free beer allowance falls from 110 litres to 16 litres, cigarettes from 800 to 200, wine from 90 litres to 4. Of course, if we do agree a trade deal, we will have to wait and see what the deal mentions. And then a couple of other quick points. So from January, you will need to have at least 6 months left on your passport to travel to the EU. EHIC card is no longer valid. You will need to check with your travel insurance. You may require different travel permits for different countries. Pet travel scheme will no longer be available. And from 2022, UK nationals will require an ESTA to travel to the Schengen area of Europe. I'll now pass you back over to Jess to just go through some of the key points that we think you need to be focusing on, and then we'll go into a Q&A, and then I'll just have some final words. Thanks, guys.
Okay, yeah, just a couple of key points. We have covered a lot, as Toby has said, so thanks for that, Toby. Just what you probably need to consider mainly at the minute is consider the impact of delays of goods arriving by road to channel ports. Obviously, the situation does seem to be getting more complex, as you've all heard about Kent turning into a car park and issues like that. I'll look up the issue regarding EU VAT registration required if you use triangulation or call-off stocks situation with customer suppliers in the EU. EU MOS registration is required if you sell digital services to private consumers in the EU. B2C supplies of digital services in the EU, you must have a separate registration. And also consider increased burden of imports into the UK from the EU, as in the admin burden, which has just been covered amply by Toby. So basically all of these will apply whether there's a deal or not. If there's a no trade deal, then we'll need further research on UK tires to see if imports from the EU have a positive rate of customs duty as WTO terms start to kick in. And really, as I say, we've covered quite a lot in this, but if you've got any questions, please do not hesitate to contact us. We've got our email and contact addresses there. And it's just, from my point of view, just like to say thanks for listening. I'll just pass you back to Toby.
Thanks, Jeff. Georgia, I don't know if there were any questions that we need to answer. If not, we can wrap it up.
We did have a question. This one's from Richard. He asked, HMRC have applied client payment to a deferred VAT period and therefore now chasing late payment on more recent return. Is that a common problem?
Can you just read that again? Sorry, I'm just trying to get my head around it. So it's...
Yeah, sure, no problem. HMRC have applied client payment to a deferred VAT period and therefore now chasing late payment on more recent return. Is that a common problem?
I actually have not come across that. So that deferred VAT payment should have been ring fenced. So it should have been almost moved to a separate account. And so any payments, only if it was payments over and above those that related to submitted VAT returns, should have been allocated to that amount. So no, that isn't common, and it is it should have been deferred. So you need to contact HMRC and get them to set that payment against the correct VAT period. If the payment matched the sort of June onwards or May onwards VAT return, I'm surprised that they would have set it against an earlier payment. But yeah, that's definitely not right. You've got until at least the 31st of March 2021 to pay that deferred amount. So they shouldn't be chasing you for that.
I would definitely agree with Toby. I haven't come across that at all. So it's yeah, definitely you need to contact HMRC directly and see if they can establish what's going on with the ledger.
Was there anything else, Georgia? Or was that it?
No, that was it for the questions.
Great, thank you. Right, so as Jeff said, hopefully this has been useful to you, and a reminder that for the most part, this has been an overview, and there is of course lots of detail behind all of the points that we've raised. So if you still have some questions or need advice regarding the changes due to COVID-19 or to prepare for Brexit, then please do get in touch. Our contact details are on screen. Thank you all for listening.
Thank you.